All right. Tasty Crypto Show. I'm Ryan Grace. With me today, Dan Cecilia, and of course, special guest, Greg Magadini, fan favorite. What's up, guys?
Hey, what's going on?
Greg, how you been? It's good to see you.
Been great. Happy to be here as always. Just talking before the show. Just came back from a couple cool places, Montreal and Lyon. Still working out there, but it's just nice to be abroad a little bit. And check out these markets from overseas locations. It doesn't change anything. It just feels cool.
I've got to ask, Montreal or France? Which one takes the cake for you?
Oh man, I think Montreal is probably where I would live, but I think France is prettier. Like there's so much in the architecture in France, and you go out to those like buildings and churches. They're from the 1100s. It's just nuts.
That's awesome. Well, it's good to have you back. It's great to have you back on the show. We've got a lot to talk about here today. A little bit of a bounce in the markets from what I can tell after some weakness here recently following non-farm payrolls, revision to prior jobs numbers as well. The age-old question, Greg, what do you make of it? What's going on in the markets? How are you thinking about things right now?
Yeah, so I think really what we saw last week is a nice juxtaposition between digital gold for Bitcoin versus risk on asset for Bitcoin. So Bitcoin kind of has that mix, whereas Web3 altcoins all have more of a risk on asset flavor. So it's really interesting to see that, non-farm payrolls coming in bad and revisions essentially like erasing the past 2 months really increases the rate hike probabilities. And so we saw gold rally pretty hard on the back of that. But Bitcoin actually kind of sold off on that. So that's where like the risk asset of the Bitcoin mixture kind of showed its hand. But that being said, Bitcoin outperformed versus, Solana, Ethereum, Web3 plays, which shows that there's a little bit of a bid for Bitcoin as digital gold. So I think, lower rates is probably great for Bitcoin going forward. We saw a nice recovery. This uptrend is intact. It's still a low volatility environment. There's no reason to panic here. There's no reason to sell any Bitcoin here. And I actually think that the risk assets recovered pretty nicely, and we could just see momentum go back into Ethereum and some of the altcoins here as well, assuming tech continues to rip higher, which it clearly is.
You think it's cut and dry? I mean, we've obviously seen the Fed funds probability shift immediately following that announcement, with the market repricing the probability of an interest rate cut upcoming. But should we be careful what we wish for? I mean, typically you see these cuts kind of follow some weakness. And as you described, we get the digital gold side of it, we get the risk asset side of it, and sometimes there's a pretty strong positive correlation between equities and Bitcoin. And I guess where I'm going is, do you think that we have to see more weakness in the market to get these cuts that ultimately probably take us closer to what I like to call blast off mode or altcoin season? Do we get that from here, or do we have to go through a pocket of weakness and there's a little bit of risk? Or do you think, as you mentioned, it's kind of just stay long, stick with the trend?
So I think overall, stay long, stick with the trend is the base case scenario. But I think what you're mentioning is for the path of rates going forward, there's kind of two scenarios that I keep thinking in my mind. There's the traditional scenario where there's economic weakness that justify a rate cut, which is kind of what you were just mentioning. I think that's kind of business as usual. And, there'll be some downside gyrations, but everything will kind of trend higher. I think if we get rate cuts in a strong economy because of essentially like pressure from the administration for the Fed to cut the front end of the curve, I think that's a whole different sort of scenario. And essentially, if that's the case, I think there's extreme steepening in the yield curve. I think the long end rates go a lot higher despite the front end being cut. Just because it's going to be sort of an inflationary, in my mind, an inflationary type of preemptive cut, as well as threatening the Fed independence. So the Fed's got that dual mandate, fighting inflation and keeping full employment. If we don't trust that they can fight inflation freely, I think that's a steepening event, and I think that's a blast off moment for crypto and for gold, for Bitcoin specifically, and for gold. Gold's been relentlessly going higher, and I don't see any end in sight here, and I do expect some sort of like capitulation move higher in gold, and I think that would be the catalyst for that, and I think Bitcoin would do the same. And there's a lot more beta to Bitcoin than there is to gold.
Yeah, and to add to that, you're starting to see a bit of, well, maybe it's too early to call it, but it seems like that bearish trend in the dollar might be resuming here. We've had some recent dollar weakness, which maybe adds a little fuel to the fire in that environment. So all that said, I mean, what are you seeing right now in the market from the kind of volatility perspective? You had a lot of great trade ideas previously here on the show, and we love your analysis around what you see with the term structure. What's on your mind from that perspective?
Yeah, I think the vol environment is super interesting in crypto right now. I have a couple charts here. I don't know if I can share one of these here, but this first chart I have up on my screen, this is really showing us where implied volatility priced forward vol, and then where where implied probability priced future realized vol, and where that future realized vol actually came in. And so what we see here is, for the exception of 3-day options, that we had over the weekend, implied is constantly overpricing realized, and it's by a good amount too. So especially if you look at the long end, I mean, you're seeing implied at, just call it 40, 44, but realized really coming in only at around 30. So the way that I like to think about this is that the variance risk premium of selling options is really harvestable right now, and there's good edge in being short the options in Bitcoin. If I look at term structure specifically, just to kind of get an idea here, we can see right here, this is the forward vol in the orange dotted line. So that's showing us the volatility between any two expirations. And we really see that December contract being sort of the point of the most expensive point on that curve. So there's a lot of premium being bought in those December contracts. Assuming all else equal and the term structure stays the way it is, we're just going to roll down to current realized vol levels of around 35. And so there's a lot of juice there for Bitcoin covered call selling, even delta neutral types of strategies. I think that's pretty interesting.
What do you think the explanation is for, the elevated premium that you're seeing there towards the end of the year? I mean, is it just people coming in and they kind of come at it with this perspective where, look, I think Bitcoin, name your arbitrary price, 150,000 year end sounds good, or is there, more to it?
Yeah, there's a little bit of speculation in the market. So we just had some regulatory clarity with the Genius Act and the Clarity Act. There's also some speculation in the market around sort of, what's this Bitcoin reserve going forward? Is it just, not selling government-owned holdings? Is there an event of potentially adding to those holdings, something like that? So I think a lot of sort of that regulatory uncertainty and hope for an event is going to be kind of fleshed out here to year end. So I think a little bit of that is the pricing. But also, let's keep in mind that this contango term structure has been pretty steady for a while here. Let me just show this chart. So this is showing us the term structure shape through time. So a 1.0 reading is a perfectly flat term structure. We're above 1.0 like we were during the election or the inauguration or Liberation Day. That brings us into backwardation. But really, since Liberation Day, we've been in this constant contango form. And that's just also a property of this shape. So, if you're consistently in contango and you go a couple months out, it's just going to be an expensive point on the curve just naturally. So I think it's a little bit of a mix of those two things.
Is it fair to say you look to sell that longer term volatility, and if you're trying to take a shot here on short term price action, you want to stay kind of in a near term duration in that sense, something that's got a little bit less time on the side?
That's exactly right. As long as we keep this shape, that's the way to do it. Long-term options are just going to be naturally overpriced and roll down the contango curve. And then if you're trying to trade short-term price changes, really getting some gamma on the cheap at the very front end of the curve, call it dailies or weeklies, that's going to be the best bang for the buck.
Okay, yeah, because it's interesting. Dan and I have noted how, and we just rank volatility kind of or implieds on a 1 year basis. A simple approach, but gives you a sense of where you are, relatively speaking. And it gets lower and lower every time that we look at it from that perspective, and maybe continues to move lower here, as you've mentioned.
Yeah, and we talked about some of the term structure and kind of how you'd play this, and you had an interesting trade idea that I want to dig into in the newsletter. So you had sell the 150,000 Bitcoin call against the spot 2.5 BTC delta exposure. Can you walk us through like the risk reward on that, or how you think about like sizing a trade?
Yeah, exactly. So that's just a delta neutral kind of vol play. So basically, I'm selling a 25 delta call, so that gets me short 25 deltas, and I own the underlying Bitcoin for 0.25 Bitcoin. So that flattens up the short delta. So now I'm long delta on the Bitcoin side, short delta on the option side. Now, one of the nice things is if the volatility shape remains the same, each day that goes by, there's a little bit of theta, and then there's a little bit of contango roll down. And so as vol comes out of the market, you're naturally picking up deltas. So there's a little bit of you don't want the market to rally too hard, too fast, because then you're just going to be short that short call in your 25 delta position in Bitcoin. It's not going to be enough to compensate for that. But as long as we continue to grind higher the way that we have been, basically what we're going to do is that your spot Bitcoin is going to gain as we grind higher, and then that option is just going to bleed volatility and bleed away its deltas as we approach expiration. So it's a great way to essentially have very little risk, so to speak, in a situation where we continue to grind on a steady path higher. Caveats there: crash down or crash up. Those are the pain points. So again, this is still a short vol trade. So you don't want crashes in either direction. But that's kind of the trade-off that you're making in that type of position.
And I might have missed it, but what expiration would you look to do that in? Is that year end where we've seen these elevated premiums, in the December expiration, or how do you think about that?
Yeah. Yep, I think really selling the most expensive point on the curve is the most interesting. So you can just see here on this curve, the December contract is trading about 44 vol. The end of October contract is trading about 42. The end of September is trading about 37. So basically, every month that goes by, you collect that theta, but then you also get that grind lower down the curve. So selling the most expensive point on the curve is, in my mind, the most interesting.
And I guess I got one last question for you on this trade specifically, Greg. Presumably, when you talk about, okay, I want a quarter of a Bitcoin, I'm going to sell the 25 delta call against it in December. You can do that on an options exchange like Deribit, for example. Is there a similar way to set this trade up or to get similar exposure with IBIT? Is it, and it's not going to be perfect in terms of the delta hedge necessarily, but is another way to look at it just coming in here, I want to own 100 shares of IBIT, or I guess depending on the capital that you have in your account, you could size it so that you have 25 shares and you sell the 25 delta call against it. But is there a similar approach when you think about some of the ETFs and the options on those now?
Yep, it would actually be pretty much the same identical trade and should be very easy to replicate. You just look for the 25 delta IBIT option that expires in December, or you can even go out to the January one just for liquidity reasons. And then you buy 25 shares of IBIT against it. And so that's essentially the exact same trade.
Yeah, when I'm looking at this right now, I mean, obviously the market for these options is closed, but it kind of puts you at about the 85 strike. It's a 22 delta currently, or you could go to the 80, which is a 28 delta, given the $5 increments there. But you're going to get anywhere from $2 on the 85 strike, or almost $3 on the 80 strike. So a lot of premium in there, as you mentioned.
Mm-hmm.
So another interesting one from your newsletter was the Bitcoin versus BTC versus coin vol trade. So Bitcoin versus Coinbase vol trade. Sell the Bitcoin December call, buy the coin call spread. Are you still, what do you look for there, and how do you manage that, like a cross-asset vol trade like that?
Yeah, so obviously there's a lot of sort of rebalancing considerations to keep in mind. But one of the things I really like about, let me just go to Coinbase here real quick. So one of the things I really like about Coinbase, and we've seen this post earnings as well, is that the volatility tends to pay option buyers. So the realized vol exceeds the implied vol quite often. And so if we just look at this chart that goes back to March, the orange line is realized vol, the blue line is 10-day at the money implieds. And so what we see is that realize when it does underperform implied, it does so by, call it, 20 points, 25 points. But when it overperforms, we've seen realize exceed implied by nearly 100 vol points. So we haven't seen this in Bitcoin in a long, long time. And we'll probably touch on this in a little bit, but MicroStrategy also hasn't done this since February. So Coinbase is still the one sort of crypto asset that's really paying vol buyers. And so whether you're trading short or long, there's an interesting type of trade to do here. I just like the long side to offset my sort of short call on the Bitcoin exposure. And the idea here is that you buy that call spread in order to get theoretically some upside crypto exposure. A lot of the Coinbase performance is correlated to Bitcoin prices. It's not a perfect correlation. There's definitely a beta multiple there that you got to think about. But basically what you want to do is you want to balance the deltas accordingly. So you would buy enough call spreads that the dollar value of the delta of the call spreads in coin is similar to the value of the short Bitcoin call in dollar values, and then you scale that for beta. So let's just say Coinbase has a beta of 2, and your call spreads are equal to, call it, 20 shares of coin. So it's like $6,000, 20 shares times 300, $6,000. The beta of 2 is equivalent of $12,000 of Bitcoin. And then if you go into the IBIT market, you would sell calls at the 25 delta. You sell a ratio that gets you around $12,000 of exposure, short exposure. And the idea here is that your Coinbase on an upside move will outperform a lot what the Bitcoin market will do. And you see this being borne out in truth for the volatility markets of these two assets.
Yeah, I personally like this trade a lot. And obviously, you don't see this spread in there as you're showing on the screen all that often. But I think we're also in a market environment where, anything is possible, but it's unlikely that we see Coinbase just jump off a cliff. It's already done that post earnings. You probably get a recovery here, and I think that they would trade with a stronger positive correlation moving forward, especially if we're in a, the bull, if we truly are, which obviously I believe, in the bull market that we've been in and remain in here for crypto, generally speaking. Like, they should both go up together, I guess is what I'm trying to say.
Yes, they should. There's something to keep in mind that we noticed in the earnings report for Coinbase. So one of the weak points and the reason why the earnings report disappointed so much is that the retail flow for Coinbase was lower than expected. That's really how they make their money, is in retail flow. So then that opens up the question, is retail not participating in this crypto rally, which I find that hard to believe, or is the retail flow just trading somewhere else? Are they just trading the ETFs instead of trading directly on Coinbase? Are they trading at some of the competitors such as Kraken or Bullish or Gemini, stuff like that? So in my mind, the edge that Coinbase provides is that they have a bunch of altcoins listed on their exchange. So that makes me theorize that really this trade, the way it performs, is if we get alt season. If we get alt season, then retail has to trade on Coinbase to buy altcoins. If that's the case, Coinbase should outperform because it has a more direct exposure to altcoin crypto trading.
Yeah, that's an interesting perspective, just given the swath of tokens that you can trade on Coinbase, and maybe that is your indicator of whether or not we're in altcoin season. Everybody asks that question. We look at Bitcoin market cap dominance and some other ratios to get a sense of that. But I'm going to start thinking about it from the lens of Coinbase. To that point, though, Greg, I want to ask you a little bit more about, your view on, is retail participating right now? Because when I look around, the narrative has shifted very quickly to ETH. You have these treasury companies that are being spun up. People are adding ETH and other crypto assets to their balance sheet, but ETH is kind of taken center stage here. From the people that you talk to in your circles, I mean, what is driving this market? Because I don't think you really see, as people like to go to the Google search trends, or, you have your friends that are texting you that aren't in the space, but all of a sudden are asking you about whether they should buy this token or that token. I mean, are you seeing any of that? Because my view is that you really aren't seeing this kind of rabid retail participation yet. Do you see that as well, or do you have a different view?
I think I do see that a little bit, because in past bull markets, you're right, we get our friends reaching out to us looking at really cheap altcoins. That's typically the sort of altcoin season bull market property, where everyone wants to get long crypto, but they want to buy something cheap that hasn't moved yet, and that sparks the altcoin season. We haven't really seen that part yet. What we've seen so far is really macro-driven and regulatory-driven flows into the major pairs, Bitcoin, ETH, a little bit of Solana. But really, the macro narrative is driving Bitcoin. So I would say that's 50% of the story. The other side of the story is going to be more around regulation. So in my mind, the more regulatory clarity that we've got, or that time goes by for that to materialize into the market, we've got some really nice bills just recently signed. I think that's going to be really good for the Web3 narrative, the altcoin narrative, a lot of tokens that were maybe deemed securities. Now people don't have to worry about that. The Tornado Cash guy, his case was essentially dismissed. So there's all these sort of these preventions going away from altcoin season, but I think there needs to be time for that to trickle in the market. So I think that's a little bit of the other side of the equation that we're waiting on. But yeah, that's kind of how I'm thinking about it. Long story short is we haven't seen the full-on FOMO retail flow into altcoins yet.
Yeah, and on that note, if we know rate cuts are coming in September, right? There's a 90% chance of that. Labor market weakness you covered in your newsletter. Where do you want to be positioned in crypto if this is all coming and lining up for this altcoin season? Do you just stick with majors? Should we look to alt layer ones? Is something more deep in that Web3 DeFi space the way to go? Or, hey, do we, maybe something new? I don't know, these content coins are big, or, meme coins. So where would you position yourself if we know this like macro setup is happening?
Yeah, I still like the macro setup the most. I find it the most interesting, especially because it's the most optionable. But one more play that kind of comes to mind is if we're thinking about the macro play and we're thinking about where retail is trading and how vol is lining up, that really brings me to MicroStrategy. So MicroStrategy, since essentially February of this year and sort of downside Liberation Day vol, the volatility for MicroStrategy has been pretty low and consistently steady. So in my mind, this creates a nice, MicroStrategy has a higher vol than Bitcoin. So when I think about essentially buying Bitcoin and selling that covered call against it, or that delta neutral ratio call, a more interesting way of doing that in my mind is actually selling the calls on MicroStrategy, specifically 2x ETF MSTU MicroStrategy instrument, because there's going to be a performance drag over time of the 2x ETF. So the asset kind of decays and underperforms MicroStrategy. But then MicroStrategy also has interesting dynamics. So there's a premium over asset value that MicroStrategy trades at. Well, since the November election, and where we really saw MicroStrategy break $500, that premium's kind of been degrading away. So the degradation of the premium prevents prices from moving too high too fast. Then you have the volatility itself is pretty low and steady. And then you have an instrument like MSTU, which is 2x MSTR performance, daily rebalance, that has a drag to it as well. So now you can sell that call on MicroStrategy and use that to, maybe buy that Coinbase call spread, or maybe trade Bitcoin underlying against it. So that's a nice way to trade the altcoin season coming on. So if we do get altcoin season, yes, that's good for MicroStrategy, but it should be better for something like Coinbase and in the vol markets. All else held equal, really prove that trade will be more beneficial to long volatility on Coinbase than it would be to long volatility on MSTU or MSTR.
And when you look to sell that call, are you doing that in MSTU or are you sticking with MSTR?
MSTU, because I think the MSTU is going to underperform MSTR, and MSTR is going to underperform Bitcoin, and Bitcoin would underperform alts in an alt in rotation.
And that's, again, due to the rebalancing or the drag from that rebalancing on the leveraged ETN.
Yes, exactly. And for anyone who's kind of new, anyone in the audience who hasn't really looked at the 2x performance drag, really all that it is that when the asset drops, it drops from a higher denominator. And when it rallies from a lower denominator. So the percentage drop and percentage gain might be the same, but the dollar value are going to be different because where that percentage is based off of. And so the higher the volatility, the more that the drops are bigger in dollar terms, and then the rallies are underperforming in dollar terms. So over time, that just degrades away.
So kind of similar to what we see in some of these leveraged volatility products.
Yeah.
Okay.
Exactly.
Real quick on the MicroStrategy note, I'm curious what your opinion is, if you have one or if you've dug into this. Do you think the way they're issuing this preferred share and this MNAV benchmark, do you think that's sustainable long term? I was on a couple podcasts where people were asking me this, and I wonder what your take on that is.
Yeah, I'm still undecided in that a little bit. I do think, basically what they're doing is they're getting cheap capital funding to get you a levered position into Bitcoin, and the shares are worth more Bitcoin over time. I do think that type of trade cuts both ways. And so it'll be interesting to see how that performs on a severe pullback or God forbid, an actual sustained bear market rally, or bear market sell-off, I should say. So I'm still undetermined. It's kind of a wait and see for me, but it's definitely interesting to see what's going on there.
Yeah, that's a great point. That's what's kind of, I wouldn't say terrifying, but maybe slightly scary in that all of these products that in some ways maybe have certainly fueled the narrative and possibly fueled the price action that we've seen have all launched and have come to market recently in this environment. It's not like they popped up kind of at the lows here. So we really haven't seen a market environment which could have a negative impact on trading activity here with some of these products.
Mm-hmm.
Greg, one more for you before we let you go. A fun one. I know you're typically in the volatility products and kind of have a more of the derivatives angle in terms of your trading. But ETH versus Bitcoin, everything we've walked through, the macro setup is there. Liquidity looks pretty good. Rate cuts on the horizon. We've got some policy tailwinds as well. If you had to pick one or the other, where are you?
Yeah, I think ETH right now is making its comeback. I think ETH making new all-time highs is very logical. It should that makes sense to me. I'd be very, very surprised that we don't see new ETH all-time highs. And those all-time highs from these prices are about, right now we're at 3,600, so call it about a 50% rally. So I think we get ETH all-time highs before we get Bitcoin 155.
Awesome. Well, we'll leave it there, but before we let you go, where can everybody find you? You put out a fantastic newsletter. I am a reader myself. How do people get on the list?
Yeah, absolutely. So our newsletter is written weekly. It's free. It's at amberdataderivatives.substack.com. And then you could check out all these charts for free with a free email sign up at pro.amberdata.io.
Awesome. Well, Greg, thank you as always for coming on. Looking forward to having you back soon. But that's going to do it for our show. We'll be back on Monday. Until then, I'm Ryan.
I'm Dan.
Peace.